Welcome to Accounting High.
If you are DIYing your financial statements and you are not an accountant, there's 100% chance that you're going to have to pay a big fee to have somebody go back and do retroactive financials for you. What we're trying to do is we're trying to tell a true, accurate story of what's actually happened in the business, and we're trying to build trust. So this is really, really important part of the process. It's their first look. It's their first peek. It's like them showing up to the front of your house. Like imagine showing up to an open house to buy a new house and the whole front yard has like an RV in front of it and there's weeds. Like even if the house inside is immaculate and all brand new construction, you're probably going to like just drive
You
right
go
back
inside
by it and not
you
even
got
go in.
A kid in a diaper running around and another kid chasing him with a fire hose inside the house.
Check out the cash flow show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the cash flow show. The cash flow show. Listen and learn. We'll show you how to pay yourself on what your business earns. With Nikole and OKR.
You vibing over there. What's up, Nikole?
What's up, Slim Shady?
Slim Shady. I'm wearing my Slim Shady t-shirt today. It's a plain white t-shirt sold by Slim Shady himself.
Marketing genius.
Yeah. What are we talking about today, Nikole? It feels like it's been a while since we've recorded.
It's been a week? I don't know.
It's been a week. We took a week off for Memorial Day, so we're back.
That's right. So today we are talking about getting your financial house in order to sell your business. All the things that you should be getting ready for, planning for, to make sure you get the max value when you sell your business and make sure you look good in front of buyers.
Okay. Look good in front of buyers and just getting mentally ready for that change too, because that's going to be a big one. So even if you're thinking about selling in the next few years, or if it's on the horizon, some of the things that we're going to be talking about today are things you can do to mentally prepare and to start changing things foundationally to make your business more appealing to buyers or more valuable to buyers. Is that right?
Right. Yeah. Typically, if you want to sell your business, you want to start thinking about these things at least a few years before, because it gives you the opportunity to make changes, and ultimately you'll end up getting a higher value for your company rather than trying to sell your business in a scramble and then fix things on the back end. And actually, I heard a stat the other day that I think 80% of businesses will never sell. And a lot of times that's because either there's no value in them, or the business owner, something happens where they may get sick or they may die. And so their financials were not in a state, their business was not in a state where they could easily sell it by whoever took over the business wasn't able to sell it. So if you do these things, then your business will be ready to sell at any time. So if an emergency happens and you need to sell it quickly, it's ready to go, and you won't sacrifice dollars for having to sell it quickly.
Yeah, I feel like there's a lot to unpack there anyway. With an owner that is mainly doing everything in a business, that everything kind of requires that owner, that's a hard business to sell as it is. So that's one thing that all of the owners listening should be aware of, that if you are performing all of the tasks in your business and you don't have any redundancies, or you don't have systems and processes set up for you to step out of the way and let the business run without you, it's going to be hard to sell your business anyway. So all the other things that we're talking about won't matter if that's the case too.
Yeah, think about it. If you were going to go buy a business, you don't want to go buy a job, right? You'd rather buy a business that's running without the business owner actively having to go run the machines, work with customers, do the work, right? You want to just buy something that's more passive. So part of creating value is spending the time to get yourself out of the day-to-day. But a lot of it is, there's several other levers that we'll talk about too as we get into this.
So, yeah. So getting the house in order. There are two types of things that we're going to talk about today. One is more strategic things that you can do as an owner, or that you can start looking at, and things you can affect. And this is over periods of time too, throughout your life of your business. And then there's tactical things that you probably should have an accountant do or handle for you, or in your in-house accounting team. So let's start with some of the strategic things you can do as an owner.
So the first one is customer concentration. So I have this in my business. I'm not trying to sell my business tomorrow, but I know that there's a certain amount of clients that if they left, it would significantly impact my business. So when you go to sell your business, that creates more risk for a buyer because, hey, you may have this $10 million business, but if you have one client that makes up 2 million of that, well, all of a sudden, if they're paying a 2 times multiple on your business, that goes from a $20 million business to a $16 million business, right? And so as you're preparing to sell, one, you want to make sure that you as the business owner aren't the only one who has the relationship with the customer. And two, that a small percentage of your customers don't make up a large percentage of your business.
So this is kind of like your 50-30-20 rule, but back to the one I originally compared it to, the 80-20 rule. 80% of your clients, or 80% of your revenue should not be 20% of your clients.
Yeah, so typically we don't want one customer to take up more than 10 to 15% of our revenue. And sometimes buyers will actually exclude that from your valuation.
Oh, really?
Yeah, they'll actually take those out and say, we're not going to include that in your revenue when we're doing our valuation.
Interesting.
Yeah.
So yeah, those are things to consider, because a lot of times some businesses really are buoyed and they grow through those one or two big clients. So it's something to consider, and diversifying is something we've always told our clients too. Diversify your base.
Right. And like I said, I've had that over the years, but I'm small. I can go get another client. I can hustle and replace that revenue. If I was going to sell my business in the next few years, I wouldn't take on the big clients anymore, right? I'd say no to those, or I'd reduce our scope. So you can actually go out to some of your clients and say, hey, we want to reduce our scope with you, or reduce the number of orders you're ordering from us in order to reduce that concentration.
Yeah. Great things to consider there, though. So customer concentration, make sure that it's not too concentrated. Make sure you got a well-diverse customer base. Still concentrated on what you do for those customers, but make sure that you diversify. Let's talk about the next one on the list here.
So the second one is quality of earnings. And what I mean by that is your revenue that you earn, is it recurring revenue, or is it like one-time project work? Or is it something that you have to, let's say you sell online courses or something, and for every $20 course you sell, you have to spend ad revenue. That is less appealing than, say, if you had a community or you had recurring revenue, or our business, service businesses, having recurring contract revenue is more ideal than one-off project revenue.
Oh yeah, recurring revenue is over everything. Like, you've talked about, you've had some clients that their stuff is very seasonal or very dependent and heavy on one large order or large client that they would service. There's no predictability there. And there's also not something that you could probably step away from if it's highly customized and very large clients there too. So all things to look at when diversifying. I mean, I think that your revenue model is very important in the value that you can get for the sale. So looking at your revenue model right now and looking at things you could potentially do in the future to make it more recurring or more appetizing for somebody to purchase.
Yeah. Or if the recurring is only one small portion of it, can you start to refocus and growing that service line over your more lumpy revenue? Think about it like a buyer. They want security. They want to feel safe.
Lumpy
they want
revenue.
the most. That's why I call it lumpy revenue.
I like that. Sorry. Think about a client.
No, I'm saying think about it from a buyer's perspective, right? They want safety. They want security. They want the sure thing. So having those long-term contracts or recurring revenue is a safer purchase for them. Rather than, hey, you, the owner, leave. I'm depending on a pipeline coming in. Usually the owner is doing the marketing, biz dev. So the fear is as soon as that owner goes away and we don't have recurring contract revenue, our pipeline stops and then we bought this thing and then it goes away to nothing. But a lot of times there'll be clauses, right, in the agreement where there's a clawback. So if during the first year the company loses revenue, that can be clawed back from the seller. So usually the seller stays on for 1 to 3 years to successfully transition the business, and then they may get a bonus at the end or a payout at the end based on retention.
Yep. We had that when I purchased my business. So I paid close attention to all of the things that didn't happen after that first year because there were some benefits to that as well. It affected the purchase price. So this next one is really great because it segues us into the tactical too, that you would work with an advisor, but this next one is working with an advisor. Those are things that could definitely help you sell for a higher multiple or a higher value. That being, advisors have worked with other businesses and helped successfully sell other businesses. Both of us have had clients that have had successful exits, and it requires a lot. So the rest of this episode is going to be all the things that we do with our clients to help them get ready for sale.
Yeah. So when you go to sell your business, you are going to end up working with a lot of different people if you do it right. I do not recommend doing it on your own if you want to maximize the value.
You could get taken advantage of if you do it on your own, for sure.
Yes, absolutely.
Nobody should do that on their own.
Especially if the other side has a team of professionals, right? There is a cost to working with professionals, but typically the increased value that you get from the sale outweighs that. So a lot of times it's the first place that you want to start before you sell your business is to work with your financial advisor to figure out what is the dollar amount that I actually need to have in the bank in order to live the rest of my life on, right? Like I couldn't go sell momentum right now and sail off into the sunset. I would need to go get a job because it's not enough cash to retire on. And so what you might do is you might go work with an advisor who says, hey, maybe it's $7 million is the number where if you put that in a bank account, you can make $200,000 a year comfortably on that, which you could continue living your current lifestyle, whatever that lifestyle you desire is. But when you start doing that, okay, so if I need $7 million in the bank, what does that mean I actually need to sell the business for? Because we also have to consider taxes, broker fees, all the other stuff. So then that's when you need to get the tax accountant involved, right? To figure out what are the tax implications and then how do we optimize it so you're paying the least amount in tax with some strategies around there. And you probably want to work with a tax accountant who specifically deals with business sales because they're going to have a level of expertise. Scotty, I don't know if you guys deal with this a lot or if you have, like if you refer that work out.
We deal with it. Yeah. We deal with it because anytime our clients are selling, we're dealing with the broker and everything. We don't specialize in it. People don't come to us saying, well, I'm ready to sell.
Okay.
We just
and maybe
it helped a lot of clients over the years.
Right. So you have a certain level of expertise just from experience. So then sometimes, if you have a larger company where there could be a lot of opportunity, there's a big swing in what the business could sell for, right? You may hire like an M&A consultant to help you leading up, maybe 3 years before you sell, getting the right management team in place, making sure you have the right marketing engine in place, making sure you have the right hiring system in place, all these systems to really increase the value. So a lot of times these consultants will come in. Sometimes they'll end up taking like a percentage of the sale as their payout so that they have a little bit of skin in the game. Some will just do it for a retainer over a certain amount of time, and then some will work on an hourly basis. But their whole goal is to maximize the value when you sell. And they're not the broker. They're not the one actually. Well, some of them can also go find buyers for you too. But most of the time, their main objective is to increase the value of the business before sale.
For our listeners, M&A is mergers and acquisition, right?
Yep.
Okay.
Yep. And then you might get into, so then your M&A consultant, they might refer in a business broker, and the business broker's job is to help you find buyers and then actually negotiate the deal. And they do operate on a percentage of sale basis on their payout. So they're kind of like the quarterback. They know all the people involved. They know what you need to do. They're negotiating for you on your behalf. And they're trying to get the deal done as quickly as possible so they can move on to their next job.
So that's the first person you should probably reach out to, right? Since they broker everything else and they probably have people they would recommend.
Yeah, it can be if you don't know anybody. They tend
sort of like your
to have
general contractor.
Yeah, so a lot of times the brokers will refer us in. So if they get an inquiry and then the books are a mess and they're like, I can't put this in front of a buyer. So then it has to come to the accountant to go for us to clean up the books.
Dope. Let's get into the tactical here. So this is where a lot of these things would happen. This is what you're going to get met with when you meet with a business broker, or and you're getting ready to start selling. These are the things you're going to need. So knowing this ahead of time is probably going to help, because especially the first one, you're going to need 36 to 60 months of actual accrual and industry standard financials. It's a lot, especially for a business that hasn't been keeping up with a lot of that stuff too. I would hope that they're at the point where they are keeping up with it, but this is serious though, right? Explain to me what this means.
Yeah, if you are DIYing your financial statements and you are not an accountant, there's 100% chance that you're going to have to pay a big fee to have somebody go back and do retroactive financials for you. And the challenge is most buyers will want those financials to be on accrual basis. It's really hard to go back and do financials on accrual basis. It's easy to do them on a cash basis. So, and you can sell a business with cash basis financials, but ideally we want to see consistency month over month. And what happens on cash basis, especially if you're not a recurring revenue type of business, is if you look month over month, you're going to see these large swings. And so what we're trying to do is we're trying to tell a true, accurate story of what's actually happened in the business, and we're trying to build trust. So if you put crappy financials that don't make sense, that are all over the place in terms of profitability and revenue, right, and balancing all over the place, what you're doing is you're eroding trust with a buyer, and you're not really accurately telling the story of your business. So this is really, really important part of the process. It's their first look. It's their first peek. It's like them showing up to the front of your house. Like imagine showing up to an open house to buy a new house and the whole front yard has like an RV in front of it and there's weeds. Like even if the house inside is immaculate and all brand new construction, you're probably going to like just drive right back by it and not even go in.
A kid in a diaper running around and another kid chasing him with a fire hose inside the house. It's a mess.
Yeah. So we want to make a good first impression. So that's why it's really important. So that's why instead of waiting until right before you're going to sell your business and do this project, hire a good outsourced accounting firm who can have good financials for you every month so you can actually run your business and make good decisions. And then if you need to sell, you got all your stuff ready to go. You don't have to go and do this big project.
Yeah. So
okay. So the second one is that we want our financials and our tax return and our payroll tax forms to match.
That's something that a lot of people might take for granted if that always does match, but that's also like a big deal when they don't.
Yep.
When the books don't match the return and then the payroll taxes don't match too, it's a mess. But keep going. I didn't want to interrupt. It's just
no, and I think this is one thing that at Momentum, like when we onboard a new client, we always start with the last year's tax return and we tie out Schedule L. That's a big part of like quality accounting that our clients are never going to understand or probably value. But it is really important if you want to sell your business to make sure that your balance sheet on your books, like in your QuickBooks Online or whatever software you're using, matches. It's called Schedule L on your tax return.
Yeah. I don't think anybody needs to go look up their return and look up their Schedule L right now, but just know that accountants know where this is. And that's like your gut check too for everything else. Like if that does align and that does work out, then it may make everything else a little bit easier to review. Right? Like how often does that even happen when you look at a new client and you look at their Schedule L? How often does it actually
a lot.
agree?
Well, so here's my take on this without getting too technical. I always want the Schedule L to be on accrual basis and then the tax accountant to do an adjustment to get to the cash basis income on the tax return, because that'll ensure that the Schedule L always ties out. But I don't think we need to get into the technicality of that. Just know that it needs to tie out, and not every most bookkeepers don't know how to do that. And a lot of tax accountants are lazy. So
another thing too, payroll tax returns are actually different tax returns that you can use to make sure that they agree with what's on your financials. So those are filed as well by your payroll company. Those payroll tax returns better agree with the tax return and what's stated on the financials.
Yes, so that's a big part of the accounting process. Again, if you're DIYing, you're not going to know how to do this, and a lot of bookkeepers don't know how to do this, but we also want to make sure that we're tying out every month, we're tying out our payroll reports to our profit and loss statement. So that's a big red flag if those don't match your P&L.
All right. And now let's talk about, you mentioned accrual. Well, that means that your schedules for payables and receivables better be in line too, right?
Right. And just because we have AP and AR does not necessarily mean we're on accrual basis. So I won't go into the technicality of that.
Say that. I knew you were going to say that.
But so one thing I see sometimes when I have a prospect or something and their books are a mess, one of the things I always look at when I'm doing our health assessment is I look at their accounts payable aging, which is all the bills that you owe to your vendors in buckets, 30, 60, 90-day buckets. And then your accounts receivable aging report, which is all of the invoices that your customers owe you. And it amazes me that there's business owners that never look at these reports. So you should be looking at these reports weekly if you have AP and AR, if you have bills that are entered into your system and invoices that you send out to customers. If you have old receivables on your books, that could be an accounting issue. I've seen situations where like there's negative AR on there. So that just tells you that your books are completely wrong if that's the case. Or it could be that you have old receivables on there and you just need to write them off because they're uncollectible. But if you have a bunch of those on there, what that's going to do is it's going to create doubt with the buyer because you have all this, they're looking at your revenue, right? They're valuing your company based on your revenue and net profit. But if you're not collecting it, then they're going to be like, what the heck? This doesn't make sense. Like, we're going to devalue your company because you obviously have a collections problem, right? And then on the other side, if you have a bunch of old bills that you owe, they're going to be like, why the heck can't you pay these bills? Either you're stiffing people and you're or you don't have cash flow to actually pay them. Or if there's just old stuff on there that hasn't been cleared off, that could be an accounting issue.
Yeah. The big thing here too is these are all foundational issues. If you have that much AR and that's sitting there uncollectible and that's what's buoying your business too, you shouldn't be in business. Like let's work on that. Let's work on the AP and the AR because that's not something that I even consider. You shouldn't have that in business. If you have recurring revenue and if you're running the right business model, you shouldn't even have any AR, right? Like, I guess you would in some cases. I'm sure you have clients that have no choice based on the vendors they work with, right?
Yeah, there's definitely going to be some situations where if you're working on like enterprise companies where you just can't automate those payments. But I had a prospect the other day who had like 5 pages of AR aging, 90 days, 60 days, and they're all negative. So they take prepayments. So basically their bookkeeper just wasn't competent and wasn't doing things correctly.
Those are payables, right?
No, it's receivables. No, it's receivables. Like their customers prepay them.
Oh, okay.
But it was all stuff from like 3 years ago that were still on the AR aging. My point with that is like, how as a business owner have you never looked at your AR aging report? So anyway, as a business owner, please look at your AP and AR aging reports every week.
Yes, if you have that. Next one is more of a clerical thing too, something that an accountant can do to help, but these are things that could be on the books that probably shouldn't be there, but fixed assets that are really old. That's something that's probably just sitting on the balance sheet, right?
Yeah, typically if you have an office and let's say you throw away a bunch of computers, on the accounting side, we don't see a cash or credit card transaction or a bill come through, right? So like we're remotely doing your books. We have no idea that you threw away those computers, but they're still going to be on your balance sheet. So when a buyer, if they are buying the assets as part of the sale, you want to make sure that they're accurate. So you're scrubbing through that fixed asset listing, which you can also find on your tax return. A lot of businesses don't maintain a fixed asset schedule outside of the tax return. So there is a report that you can pull there. Go through that with your accountant and just go through it and cross off the ones that are no longer on site or you no longer own.
That's important for property tax listings too, because you could be paying property taxes still on stuff that you have disposed of. If you don't dispose it on those returns, I don't think most people prepare their property tax listing until they get audited. It's something that most all businesses in any county that you exist in, should be
Yeah.
filing every year, and it's usually something that goes with the tax return. So talk to your tax accountant if you haven't been preparing those, because you get audited one year, you're still going to have to pay all the prior years. But that's usually
right.
something that you have to keep up with, those lists just for that property listing. So make sure that agrees with the return as well.
That's a good point. Yeah. Just a little hygiene there. It's not like going to be a deal killer or anything. And the other thing you might want to do is, if the market value of that equipment, if for whatever reason it's gone up or something, I can't off the top of my head think of a reason what type of business where the assets might go up in value. You want to be able to show the buyer like, hey, it's on the books for this amount.
Only intangible stuff, probably.
Yeah.
Like,
yeah.
That's other types of specific niche things. Let's move on to the next one.
Okay, so the next one is inventory. If you have inventory, your month-over-month inventory reports should tie to your month-over-month balance sheet. So every month, your accountant should be taking the actual value of the inventory on hand at the end of the month and booking that on your balance sheet.
Every month?
Every month.
Yeah, inventory counts every month. That's really important. I don't think we do that. We do it at the end of the year.
So if you want to see like every month you're looking, so the reason you do that is because then you know what your actual cost of goods sold is. There's a plug there.
Yeah, it's important.
So then month over month, you can see what was actually sold on your P&L, not what was actually purchased when it comes to inventory.
So if people have good systems in place, good inventory management systems, it should always give you that information. You should always be currently updated. There are some clients that don't have that and actually would have to do a physical inventory count to just put that together too. We've definitely seen that. So we usually have people do physical counts at the end of the year, just for their return. But that's something that if you do have that in the reporting of your inventory management system, then you can run that on the books pretty easily. Probably.
Yeah, that's a good point. Like some of our more sophisticated clients will just pull a report from their system, and then they may do a count once a year, every 6 months, just to like true it up. Because obviously every once in a while, your report's never going to exactly tie. So either reports or counts.
We had some inventory heavy clients that we would set up the integration with QuickBooks with Fishbowl or one of these. I think it was Fishbowl that they were implementing. So then every action that happened on there updated the inventory in QuickBooks. It was a lot of work to get set up, and I don't know if it was worth it, but it was pretty cool.
Yeah, sometimes those work. A lot of times it's just easier to make the AJE, because if they're pushing some of the more modern ones, they'll push it in a journal entry rather than every single individual transaction. So because sometimes that can overwhelm QuickBooks Online if you're sending thousands of little transactions through the books every day. So just work with somebody that knows what they're doing with inventory.
Let's talk about one that's near and dear to my heart here: state and local tax compliance, specifically sales tax and also property listings, like I just mentioned earlier. There's a lot of taxes. Like there's all kinds of taxes that your business needs to be filing. And we've had so many clients come to us and say, I think I'm supposed to be collecting sales tax, or this is the best one: I've been collecting sales tax this whole time. They don't know what to do with it. They're collecting sales tax and not remitting it too. I have had this happen many times. People just don't know. They think, this is what I get charged at this place when I go there, and I have a similar business. I need to charge sales tax. Yes, everybody in Florida has sales tax, but not all businesses need to collect sales tax. Just to be clear, it's an ever evolving regulations with sales tax too. With a lot of the digital technology, some of that stuff wasn't taxable. Now it is.
Yeah, well, a lot of times, like when you set up the system, like Shopify or something, you just turn that sales tax. Yeah, collect sales tax, and then somebody sets it up for you, and you don't even realize you're collecting it. And then if you're collecting it, then you need to pay it into the state that you collected it for. I had a client once, the one that actually went bankrupt, but they got this huge audit from Texas, I think it was. And so they had like this huge $500,000 liability, but they couldn't pay it back. So they went to go sell the business, and the buyers it was just such a big hole that they couldn't get out of. Another situation I have right now is a new client we're onboarding. They do IT consulting. So they buy equipment on behalf of their clients, ship it to California, and then they ship it to wherever their client lives in multiple different states. In that case, they should be collecting sales tax in the state of the end user, but they've been collecting only California tax. Now, when they go to sell their business, when they go through due diligence, and so the buyer will end up hiring a team that does due diligence on some of these things. As part of their checklist is to go figure out if the business is handling sales tax correctly. They're going to go figure out that they aren't. And that's going to be a point of contention when he goes to sell the business.
Oh man, and tax too. There's a lot of international businesses happening, and some people don't have any idea what they're supposed to be doing for any kind of VAT or a lot of these other international type taxes. Just be aware of that. Obviously meet with a tax professional. There's a lot of technology now to help with these things. Avalara tax jar for sales tax is there's Avalara built into Xero now. It's depending on which software you're using. I'm sure QuickBooks has a lot of built-in sales tax tools, but all of this technology now is going to make it easier for you to stay in compliance. So be sure to meet with a tax advisor just to make sure you're doing all that correctly too.
Yeah, and I was going to say, even at Momentum, like we'll help our clients with sales tax using some of those tools, but we'll also refer in sales tax experts because there's so many different states and rules. Like we want to make sure it's set up correctly. Like I would quarterly check in with some sort of expert. You can find somebody from Upwork to just advise you and make sure you're doing it properly. And then you can have somebody in-house maintain it ongoing.
Oh, yeah. Here's another one that tends to happen a lot. We've had this happen a lot with clients that are getting ready to sell their business is they've been putting the owner has been using the business as sort of their way to write things off, things that maybe you could stretch as a tax accountant. You could stretch it and say, yes, you could call that business, but it's affecting their profitability. So it's like, yeah, we're paying less in taxes, but now your profitability is a lot lower and it may not be as appetizing to a buyer. Is that right?
Yeah, that's right. So some of those examples might be travel that we're going to say is a business expense, cars, maybe you have family members on payroll, any other type
different
of
discretionary events that you might throw, like a lot of the meetings expense or other benefits, like you said, cars. A lot of people will write those kind of things off. You've got all of your home office type things. Maybe that's extra on there that's getting included.
Yeah.
I think everybody has something like that if they're the sole owner of the business too.
Right. And so that will temporarily reduce your tax burden, but when you go to sell it, it could affect the value of your business. Now, your broker will go through and take those out. They'll go scrub through your P&L with you, and then they'll present the buyer a new version of the P&L with those add backs. But there's a certain point where if you commingle so much, the buyer is going to be like, I don't trust you. Like, how do I know you didn't need this car? How do I know you didn't have to travel to that event to get that client? Right. It's going to be so much stuff that you're going to erode trust with the buyer. So I would say within the 3 years before you go to sell your business, maybe don't be so aggressive with the write-offs.
Yeah, maybe don't be so aggressive. But I mean, if it's something that you can prove that would not exist otherwise, like to the buyer, this wouldn't be on the P&L if otherwise. These kind of things do happen, but
yeah. Family members on payroll, yes, probably a little tough, right? Because they don't know if the family member's actually doing work and they have to go hire a replacement for that person. But if you're like, oh, I've got my family member on payroll, but they're not actually doing any work, that can be a little bit tricky.
Oh, I can relate to that.
And there's certain things that are going to be like, you're so blatant in cheating the tax code that they may not trust you as a person, right? So they may not trust anything you say.
So there's ethics somewhere baked in here too. You have to be an ethical business owner in order to really succeed in all of this. Somebody's going to find what you're hiding, basically.
Oh, yeah.
If you're hiding something.
Oh, yeah.
You're not going to be able to sell your business if you're doing some unethical things. Yeah. That should have been the first thing that we talk about. Run your business, morally sound business, ethically. Don't cheat on anything. Don't cut corners. It's never going to work out.
Yeah. Cutting a little bit here is going to end up not paying off later.
No. So, and we've seen it happen all too many times. Cheaters never succeed.
That's right.
Let's call to action conclusion. These were great tips, great things to consider when you're ready to sell your business. Come see Nikole at Momentum Accounting. She can help you out if you're ready to do that.
Yeah. Or
New
even if you're
taxes
not.
in line, come see me.
Yeah. So Scotty's at pageantinc.com and I'm at momentumaccounting.com. But I will say, even if you're not ready to sell your business, just get your financials and all your compliance in order anyway, because it will help you sleep at night. It will help you make more money and it'll help you take home more cash.
More cash flow. More cash flow tips from the Cash Flow Show. Peace out, homies.
Alrighty. See you next time.
Class dismissed.
Yeah. So you're drowning in cash flow issues. You run a business, but feel like it's running you. Customers won't pay, but you got bills due. It appears you won't have enough for payroll coming up soon. It seems like you're running nowhere fast. You work hard, but never able to withdraw cash from the business. You get more customers, hire more employees, but still take home hardly anything. You feel like you're on a hamster wheel, frustrated cause the battle's always uphill. Even though you got a bookkeeper on your team, they send you reports, but you don't really know what they mean. Your CPA doesn't understand a thing about your business, at least that's how it seems. But if you want to get above water and grow, check out the Cash Flow Show. This is the Cash Flow Show, where we help the small business gain momentum and become profitable. This is the Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cash Flow Show. Cash Flow Show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cash Flow Show. The Cash Flow Show, where we help the small business gain momentum and become profitable. This is the Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cash Flow Show. Our advice will take you far. Cash Flow Show. Tune in with Nikole and OKR.